Hi, Lee Phillips. One of the techniques that we use for shifting income, that is, taking income that would be at the parents' level and shifting it usually down to the grandchildren or children's level, or you could shift it up to the parents' level, but the concept is to shift it to someone who is in a lower tax bracket than daddy. And it's very common, not only for tax purposes, but for asset protection purposes, to have the doctor have his x-ray machines and stuff owned by a separate company. The doctor then pays the rent. And this doesn't just apply to doctors, this applies to the guy who owns the excavation company. The excavator is owned by a separate company than the actual construction company that dad owns too. The construction company rents the excavator. What happened? We took money that was earned income in the excavation company, and we converted it to rent, passive income, in the company that actually owned the excavator. Additionally, asset protection wise, the construction company is the one that's going to get sued. The doctor's the guy that's going to get sued. The dentist is the guy that's going to get sued. And when they get sued, the equipment is outside of the realm of that lawsuit because the equipment doesn't have anything to do with the lawsuit. There's no what we call causal connection between the lawsuit and the equipment. Equipment by itself didn't cause the problem. So we protected the equipment asset protection wise, and we've gotten money down to the owners of the excavation equipment or the x-ray machine. Now, if daddy owns both of them, then that doesn't count. Can't do that. Can't convert earned income in the construction company or the practice if you own the equipment company too. IRS says, no, you can't do that. But if the company that owns the equipment is actually owned by the children or the parents or me, that'd be good, whoever you want, then they get that income as passive income. So we've taken earned income, moved it to the family as passive income, and they've got the kiddie tax on it, which prevents you from doing it in large part to children. You can still do $1,500 a year or whatever it is, and they don't have to worry about reporting or anything, so you can get a little bit out to the kids without having to worry about this kiddie tax. And we have another one, and we even have updated the kiddie tax for the new Tax Act and Jobs Act. But how do you get physically the equipment over into this company? Well, you can buy it originally in the company with money that the company owns, or what usually happens is you have the equipment in the practice or in the excavation contractor company, you depreciate that equipment on the books. Now what's it worth? Zero, right? Then for a minimal price you sell it to the company that's going to actually own the equipment. So we've gotten the appreciation or depreciation in the company where we can offset the income. We then have a bill of sale. We sell it to the company that's going to own it and rent it back. Now you need a lease agreement, an equipment lease agreement. In the accumulation and preservation of wealth set that I supply, we have a equipment lease. Funny thing, there's an equipment lease. But I need the lease and I need the bill of sale. There isn't much there, so we don't have to worry about a lot of value to the children. Or we can just gift it over. If you're going to gift it over, you have to follow a certain order in gifting. And that's another YouTube video that we've got, how to actually make a gift of in a company an LLC, a corporation, whatever it is, to someone. You got to follow specific rules in order to do that. But we now have the depreciated equipment transferred over. We've got the lease agreement back. We're going to pay the lease and we get the equipment. It's a good deal. Asset protection wise, tax wise, actually Trumpy hit the rich a little below the belt on this one. The rich are paying their fair share, trust me. And if it's mom and dad, they're not kiddies, so we don't have to worry about that. They can pay their own tax on the money that's generated here. And it may save the family a fair amount of money. So Lee Phillips talking on how you actually physically get equipment from one to the other in shifting income.